What makes one country rich from the ground beneath it, while another struggles to keep its lights on? The answer lies in the relationship between energy-producing countries and energy-consuming countries. On one side are nations with wells, pipelines, export terminals, and tankers full of hydrocarbons. On the other are nations with giant industries, transport systems, and huge energy demand. One side earns from exports, the other pays for imports. Producers worry about low prices, while consumers fear prices that are too high. Yet both sides remain locked together, because producers need buyers and consumers need supply. This is not just an energy story, but one about wealth, industry, inflation, geopolitics, and survival. Why oil and natural gas matter so much to nations and economies. Oil and gas are economic multipliers, powering transport, industry, electricity, and petrochemicals. They provide feedstock for petrochemicals, plastics, and fertilizers essential to modern life. Energy sits at the center of almost every modern economy, connecting many sectors and services. Producers can earn export revenue, attract investment, strengthen currency, and finance public spending. Consumers must import energy, manage trade deficits, and remain vigilant about global price moves. A war, a cold winter, or a production cut can ripple across the global economy and change prices within days. That is why countries do not study oil and gas only as commodities. They study energy as strategy, diplomacy, and national security. Producer economies ask one question: how do we maximize value from the resources beneath our land and sea? Consumer economies ask another: how do we secure reliable supply, keep costs manageable, and avoid inflation when prices rise? For producers, energy is income. For consumers, energy is often one of the largest costs shaping public budgets, industrial policy, and political stability. Some countries both produce and consume heavily, which complicates the simple producer-consumer divide. But the basic tension remains clear. One side earns from energy while the other pays for it. Oil and gas-producing countries build their economies around energy revenue. Countries rich in hydrocarbons can sell something the entire world needs. This creates unique advantages. Export revenue brings foreign currency, strengthens national finances, and allows governments to fund roads, cities, welfare programs, and industrial development. Governments collect money through state ownership, royalties, taxes, and long-term energy contracts. Control over reserves, pipelines, ports, or shipping routes also gives producer nations geopolitical influence over buyers and partners. Energy wealth can support petrochemicals, refining, LNG terminals, shipping, and industrial zones. But there is a risk. Heavy reliance on one sector makes a country vulnerable to price swings. When prices fall, budgets weaken, public spending is cut, and subsidies become harder to maintain. For oil producers, diversification is not optional. It is survival planning. Tourism, finance, manufacturing, logistics, and technology must eventually complement energy revenue. The hard challenge is turning oil wealth into broad-based productive complexity and lasting jobs. A country may be rich in resources but still weak if it does not build strong institutions, skilled workers, competitive industries, and future-ready infrastructure. Energy revenue can open the door, but it cannot guarantee long-term prosperity by itself. The real test is whether temporary oil income becomes permanent national capability. That is why many producer nations now focus on downstream industries, sovereign investment funds, knowledge economies, and clean energy opportunities. The goal is simple: use today's hydrocarbon wealth to prepare for tomorrow's lower carbon world. Saudi Arabia is one of the clearest examples of the classic oil producer model. Its rise was built on vast reserves, low-cost production, and central importance in global oil markets. For decades, oil exports financed roads, cities, public services, welfare systems, and regional influence. But dependence creates vulnerability. When global demand shifts or prices fall, national budgets can come under pressure. That is why diversification has become a central policy imperative. The challenge is to convert petroleum rents into tourism, manufacturing, logistics, technology, and knowledge-driven industries. Expanding downstream sectors also helps capture more value instead of exporting crude alone. Saudi Arabia shows both the power and the pressure of being a major producer in a changing energy system. The UAE and Qatar show how hydrocarbon wealth can be paired with strategic diversification. The UAE used oil income to build ports, aviation, finance, tourism, logistics, and global business hubs. This turned energy wealth into broader economic influence. Qatar followed a different but equally powerful path. It became a major global gas supplier through large-scale LNG production and exports. Natural gas often acts as a bridge fuel because it can be cleaner than coal in many power and industrial uses. LNG made gas more global by allowing exporters to reach distant buyers by sea. Energy revenue also becomes diplomatic leverage through investments, long-term contracts, and strategic partnerships. These countries show that resource wealth is most powerful when it is converted into infrastructure, influence, and diversified capability. Norway offers a very different energy story. Instead of spending all its hydrocarbon income immediately, Norway saved a large share in a sovereign wealth fund for future generations. This converted temporary resource earnings into long-term financial assets for citizens. The model works because of strong institutions, transparency, fiscal discipline, and public trust. By investing resource revenue abroad, Norway reduced the risk of overheating its own economy and created a buffer for the future. But this model is difficult to replicate everywhere. It depends not only on oil and gas revenue, but also on political culture, governance quality, and long-term discipline. Norway proves that natural resource wealth can support prosperity when it is managed with restraint, transparency, and future-focused planning. Russia shows how energy exports can become instruments of state power and diplomacy. For Russia, hydrocarbons are not just economic assets. They are tools for building long-term relationships with buyers and shaping regional influence. Pipelines create dependencies. When one country depends heavily on another for energy, that relationship can influence security calculations, foreign policy, and negotiations. But export power also creates exposure. When politics disrupt energy exports, the economic effects can be immediate and severe for producers that rely heavily on foreign markets. Export strength gives strategic weight, but it also exposes a country to sanctions, market shifts, and political shocks. Russia demonstrates the double-edged nature of energy power: influence abroad, but vulnerability when global politics turns against supply routes and buyers. The resource curse explains how abundant natural resources can sometimes harm long-term development. Easy revenue can weaken incentives to diversify. It can also damage institutions, increase corruption risks, and make public finances overly dependent on commodity prices. When prices are high, governments may expand spending quickly. But when prices fall, political tensions rise, projects stall, public services suffer, and budgets become unstable. The cure is not simply more oil or gas. The cure is better governance. Strong institutions, transparency, education, infrastructure, and long-term fiscal planning are essential. Countries must use resource income to build human capital, competitive industries, and resilient public finances. The lesson is clear. Natural resources can create wealth, but only disciplined management turns that wealth into sustainable development. Now the focus shifts to oil-consuming countries. Large consumer nations depend on steady energy supply to power factories, transport systems, cities, and daily life. For them, energy security becomes a strategic national priority. China's industrial scale and urban growth create enormous demand for oil and gas. To reduce risk, China invests in multiple suppliers, strategic reserves, overseas partnerships, pipelines, and LNG infrastructure. India faces a different but equally urgent challenge. Its growth, population, and rising mobility make affordable energy essential for development. India pursues domestic production, long-term contracts, renewables, efficiency, and diplomatic energy ties. For consumer economies, imported energy is not just a cost. It is a foundation of industrial growth, mobility, and national stability. Japan and Europe are advanced economies with limited domestic hydrocarbons. This means they rely heavily on energy imports to power industries, cities, and transport systems. Import-dependent economies must manage risk carefully. They diversify suppliers, build storage, sign long-term contracts, invest in LNG terminals, and accelerate alternatives such as renewables, efficiency, and electrification. For these countries, energy security is about avoiding overdependence on any single supplier, single route, or single fuel. A disruption in one region can raise costs across the economy. That is why energy planning becomes national planning. Factories, households, transport networks, and governments all depend on stable access to energy. For advanced importers, resilience is built through diversification, reserves, infrastructure, and long-term strategy. When energy prices rise, the impact spreads quickly through consuming countries. Higher oil prices increase transport costs for shipping, trucking, and aviation. That raises the cost of moving goods across supply chains. Factories also pay more for fuel, electricity, and feedstocks, which squeezes profit margins and increases production costs. Food prices can rise because agriculture depends on fuel, transport, and fertilizers made from natural gas. Energy shocks can then spread into general inflation. Governments and central banks are forced to respond. They must decide whether to subsidize consumers, cut fuel taxes, raise interest rates, or allow prices to pass through. This is why oil prices affect more than energy markets. They affect the cost of living. Low energy prices create the opposite effect. Consumers welcome lower prices because fuel, transport, and production costs fall. Inflation pressure eases, household budgets improve, and industries become more competitive. But for producer countries, lower prices can be painful. Government revenue falls, currencies weaken, public finances come under pressure. Large investment projects may be delayed or canceled. Growth slows, unemployment can rise, and subsidy systems become harder to sustain. This is the permanent tension in the global oil economy. The market price that helps one side often hurts the other. High prices strengthen producers but strain consumers. Low prices support consumers but weaken producers. That is why oil prices remain one of the most politically sensitive signals in the world economy. Natural gas was once mostly regional because it moved mainly through pipelines. Pipelines create fixed relationships between nearby producers and consumers. But LNG changed the gas market. By cooling gas into liquid form, exporters can ship it across oceans to distant buyers. This made gas more global, flexible, and competitive. Exporters now choose between pipeline contracts and LNG investment based on market reach, security, and long-term demand. Importers pursue pipeline diversity, LNG terminals, storage, and flexible contracts to reduce dependence on single routes. Gas also plays a transitional role in electricity systems, while renewables expand and grids modernize. LNG reshaped energy strategy because it turned gas from a regional dependency into a global commodity. The energy transition creates a major question for both producers and consumers. Producers must decide how to use today's revenues to prepare for lower hydrocarbon demand tomorrow. Consumers must reduce import dependence while keeping energy affordable and economies growing. The transition will be uneven. Some producers will adapt quickly, others may struggle. Some consumers will electrify fast, while others will remain dependent on oil and gas for longer. Old and new energy systems will coexist for many years. That means producer-consumer ties will remain critical. Future cooperation may combine hydrocarbon contracts with investment in clean technology, hydrogen, carbon capture, storage, and modern grids. The energy transition is not only about replacing fuels, it is about reshaping economic power. Countries manage energy risk through policy, finance, and infrastructure. Strategic reserves help absorb short-term supply shocks. Long-term contracts provide predictability for buyers and sellers. Hedging tools and futures markets allow companies and governments to manage price risk. Sovereign funds help producer countries smooth revenue cycles and save for future generations. Infrastructure investment strengthens resilience through ports, pipelines, LNG terminals, grids, storage, and transport networks. Technology adoption also matters. Smart grids, energy efficiency, renewable scale-up, hydrogen, carbon capture, and demand response can reduce vulnerability. The countries that plan ahead will be better prepared for shocks. The countries that ignore risk may face inflation, budget crises, supply disruptions, and social pressure. Energy resilience is now a core part of national security. Geopolitics remains central to energy. Routes, choke points, suppliers, pipelines, and tanker lanes influence global stability. Markets react instantly when a producer cuts output, a pipeline shuts, or a tanker route becomes unstable. Critical infrastructure vulnerability makes maintenance, security, and resilience a top priority. Maritime security protects tanker routes and preserves global flows of hydrocarbons. Cyber resilience protects refineries, pipelines, ports, power grids, and trading systems from disruption. Preparedness for outages, rerouting tankers, emergency fuel supply, and cyber risks can reduce panic during crises. Energy diplomacy also formalizes long-term ties between buyers and sellers. Because energy systems are interconnected, a shock in one region can create cascading effects across the planet. Energy security is now physical, digital, financial, and diplomatic. The winners of the future will be countries that transform energy revenue into diversified, knowledge-driven, and low-carbon economies. Producer countries that rely too heavily on hydrocarbons without strong institutions risk decline as markets shift. Consumers can reduce vulnerability by improving efficiency, electrifying demand, investing in renewables, and building flexible grids. Producers can invest in sovereign funds, diversify industries, support local suppliers, and build human capital. Hybrid approaches may create shared benefits. Hydrocarbon contracts can be paired with clean energy investments, technology transfer, hydrogen projects, and grid modernization. Finance will also reshape the transition through green bonds, ESG investment, sovereign fund strategies, and infrastructure capital. The future will not reward countries that simply have resources. It will reward countries that manage resources wisely. Energy transitions are not only technical, they are social. Workers leaving fossil fuel industries need retraining, social protection, and pathways to new employment. Communities near extraction sites need fair benefits, environmental safeguards, and local development. Energy justice means fair access, local benefit sharing, and protection from environmental damage. Governments must also protect vulnerable consumers during price spikes through targeted subsidies, efficiency programs, and smart pricing mechanisms. If transition costs fall unfairly on households, workers, or poor regions, political resistance will grow. That is why ethical distribution of energy revenues and transition costs is central to social stability. Energy policy is not just about markets. It is about people, fairness, jobs, and trust. Analysts use key metrics to evaluate energy risk and resilience. Trade balance shows how energy imports or exports affect national finances. Fiscal exposure shows how much a government budget depends on commodity revenue. Energy intensity measures how much energy is needed to produce each unit of GDP. Countries that reduce energy intensity become more competitive and more resilient during price swings. Import dependence reveals vulnerability to international price volatility and supply disruptions. Fiscal buffers and sovereign funds show whether producer countries can survive downturns. Diversification indicators reveal whether an economy is moving beyond one dominant sector. These metrics matter because they show who is prepared and who is exposed. In the oil economy, resilience can be measured before the crisis arrives. Oil and gas continue to shape money, power, and survival. Some countries earn from energy, others pay for it. Producers gain revenue and influence, but face volatility and long-term transition risk. Consumers gain industry and mobility, but face exposure to price shocks and supply disruptions. The global energy system depends on exchange, energy for money and resources for growth. Policy choices will define the future. Savings, diversification, long-term contracts, renewables, efficiency, diplomacy, and resilient infrastructure all matter. Old and new energy systems will coexist for years. The question is not whether oil and gas still matter. They do. The real question is which countries will use this moment to build stability, prosperity, and power for the next energy age. To reduce oil demand, smart grids powered by AI and distributed sensors are becoming essential. These systems improve reliability and allow countries to use higher shares of variable renewable energy. Electrifying transport also reduces oil dependence, but it creates new demands for electricity planning, grid capacity, and charging infrastructure. Heavy industries will need to decarbonize through electrification, hydrogen, and process innovation. The goal is clear: reduce hydrocarbon dependence without slowing economic growth. Global cooperation and financing are critical for helping lower-income countries manage the energy transition without sacrificing development goals. A resilient future requires more than cleaner energy. It requires diversified economies, inclusive policies, and stronger energy systems. Oil producers and consumers remain connected through trade, politics, finance, and technology. As the energy system evolves, this relationship will continue to shape global affairs. Until the world is fundamentally transformed, oil will remain a force behind money, power, and diplomacy. Oil and gas shape nations, economies, and the balance of power in our time. Producer countries focus on value maximization, export revenue, national budgets, and economic diversification. Consumer countries prioritize supply security, affordability, and protection from price shocks. This creates a permanent tension in the global economy. Producers want strong prices. Consumers want stable and affordable energy. That tension is one reason oil remains deeply connected to global power. Oil and gas shape nations, economies, and the balance of power in our time. Producer countries focus on value maximization, export revenue, national budgets, and economic diversification. Consumer countries prioritize supply security, affordability, and protection from price shocks. This creates a permanent tension in the global economy. Producers want strong prices. Consumers want stable and affordable energy. That tension is one reason oil remains deeply connected to global power. Oil and gas shape nations, economies, and the balance of power in our time. Producer countries focus on value maximization, export revenue, national budgets, and economic diversification. Consumer countries prioritize supply security, affordability, and protection from price shocks. This creates a permanent tension in the global economy. Producers want strong prices. Consumers want stable and affordable energy. That tension is one reason oil remains deeply connected to global power. History shows that energy price shocks can quickly reshape economies and politics. When oil prices rise, transport becomes expensive, inflation increases, industries face pressure, and households feel the impact. Behind every market chart are real people whose livelihoods and well-being depend on energy stability. Solving these challenges requires pragmatic policy, private investment, and international collaboration. The oil economy is not only about barrels and prices. It is about people, security, and survival. The energy relationship between producers and consumers will continue to shape our shared global future. As countries move toward cleaner energy, the world must balance affordability, security, development, and climate responsibility. The future will not be decided by one technology or one country. It will be shaped by cooperation, investment, innovation, and resilience. Oil built the modern economy, but the next chapter will decide who controls the future of energy power.